Still keeping an eye on futures ahead of the opening bell here. We've got just about 15 minutes until the start of trade. Futures currently mixed at this point. The NASDAQ is the lone gainer, while you've got the Dow and the S&P 500 in negative territory. So the question is, has the bear market hit its bottom yet, or will we continue to see short-lived rallies like last week's? For that, let's bring in Charles Schwab, Chief Investment Strategist, Liz Ann Sonders. Liz Ann, great to speak with you as always and get some of your insight around it. So I guess that's the question that we tee up once again, and I feel like we've discussed this time and time again of whether or not we have actually seen a bottom. But if there are three things that would actually indicate that we've hit that bottom, what would that be from your perspective?
Well, so we did check a positive box somewhat recently when the market was retesting and ultimately went through its mid-June lows. There were certain breadth indicators that actually got better. So there were fewer stocks, at new lows, even though the overall index was at a new low. That was a positive sign. Unfortunately, as the market has rallied, breadth looks kind of mediocre. So I would have liked to have seen better breadth both on the upside too. I think sentiment had gotten pretty washed out. That establishes a better outlook. But from a more macro perspective, I think what needs to stabilize probably for the worst to be in the rearview mirror would be the housing market. I would specifically look at the NIHB housing market index. Yields, I think, have to stabilize. PMIs, and then forward earnings estimates. So from a more macro perspective, that's what I'd look for to get a sense that the worst is over both for the market and the economy.
Listen, I know you're an avid earnings watcher, and we're right in the thick of things here. What has been your assessment so far?
So, weaker than the second quarter, both including energy. So right now, the blended consensus, which is inclusive of companies that have already reported, so that's their actual numbers blended with the consensus for those that are left to report, that's up about 3%. That's down from about 8.5% in the second quarter. If you exclude energy, you go into negative territory, about -4% versus -2% in the second quarter. So a deceleration. The beat rate is decent, but I think that's in large part due to the much lowered bar that analysts put on consensus since what was the peak in estimates for the third quarter back in the late spring.
Liz Ann, I love one of the charts that you actually shared this morning on your Twitter, and particularly it was around the U.S. dollar's impact, and particularly within this foreign exchange FX headwind that's continued to be cited by companies over the course of this earnings season. I mean, how many earnings periods do you believe that this could still be one of those headwinds that has to be navigated by companies?
Well, if the dollar continues its ascent, then I would say the impact on earnings, which is being felt in earnest in the third quarter, doesn't go away. If for whatever reason you see a retreat in the dollar or stabilization, I think it becomes less a factor. Then you also have the possibility of companies deciding whether or not to hedge. That comes into play, but it's being felt right now. About 40% of S&P revenues and sales are directly tied to overseas sources. For big cap tech as a sort of a monolith, that's closer to 60%. And you started to hear more commentary from companies about FX impact, the strength of the dollar impact in the second quarter. Now it's even a greater force, both in terms of the hit for the third quarter, but also forward-looking commentary.
Are you surprised that expectations around rate hikes by the Fed, they look to be beginning to roll over a bit?
They are a bit. I think the estimate is starting to move down for 50 basis points in December versus 75 basis points. I think 75 basis points next week is a lock. It does show you that trend and rate of change always matters. No one would ever look at a 50 basis point hike in isolation as a more dovish stance, but it's all relative to the series of 75 basis point hikes. I think that that's natural for us to be at the point where we start to anticipate pause or at least a step down. I'm happy that the market is no longer focused on pivot to rate cuts, which was the narrative in play when the market started rallying in mid-June. Frankly, I think that narrative made no sense because the conditions to give a green light for the Fed to cut rates I think would be much more dire economic environment and or much more significant deterioration in the labor market. So I think this shift back to, okay, maybe a step down to a pause is what we should focus on near term. That seems to me to be more appropriate.
By the time that we actually are in a recession, and of course it would be well after that perhaps that the NBER would actually determine that we were or have incurred a recession. But, all of that considered, the market's going to try their best to price that in as far ahead as possible. So when does that kind of market pivot happen, even ahead of a Fed pivot, even ahead of a recession actually taking place?
I think what makes this cycle a bit different, yes, the market peaked out on January 3rd of this year, and we went into a bear market. So that obviously does reflect the combination of monetary policy tightening and the impact of tighter financial conditions on the economy, regardless of whether or not the NBER ultimately declares it a recession. I think what makes it trickier this time and could maybe elongate the process for the market digesting the economy is the rolling nature of what's been happening in the economy, almost a rolling recession where we're clearly in it with housing and many of housing related things, but the services side has been a positive offset. And that's just the nature of the pandemic, because the demand surge fueled by stimulus had to be funneled into the goods side of the economy because services were not accessible. That was the breeding ground for the inflation problem with which we're still dealing. But we're already seeing disinflation and weak demand on the goods side with the offset on the services side. So I think there's this elongated rolling nature to the economic downturn, which makes it a bit trickier. It's always tough to call the market as it relates to the economy, but trickier because of the rolling nature of this.
It just doesn't get any easier. Charles Schwab, Chief Investment Strategist, Liz Ann Sonders, always great to get your analysis. We'll talk to you soon.
Thank you. Good morning.